Gradually, but with a sense of stability returning to the scene, let's delve into the latest data emerging from the world of RTX. Hello, everyone. Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads and also enter our giveaway. But before that, alert: this is not a financial advice video. Upon close examination, it becomes evident that nearly all the metrics are trending upwards, seemingly on a path back to their previous peaks. Take a look at this. The percentage of shares on loan currently stands at 49%, reflecting a significant change from the past. Presently, there are 26.5 million shares on loan, a far cry from the days when that number once surpassed the 100 million mark. This development suggests a possible resurgence to previous levels. Furthermore, there is a noticeable increase in the percentage of shares on loan, hovering at around 50%, specifically at 16.8% in comparison to the pre-stock split distribution, which previously ranged from 32% to 34%. Both of these metrics are reverting to their former highs. Additionally, the estimated short interest has risen by 20% over the last 7 days, now resting at 11.52%. It's worth recalling that, at certain points, we were grappling with a short interest rate of 15%, and post-split, the short interest levels averaged around 20%. This indicates a rekindled interest in shorting activities. Where does the divergence lie? Primarily, it centers around the value of short interest. The stock prices have declined, and, correspondingly, the cost to borrow has decreased by 5.7% this week. According to the architects of this financial landscape, the current cost to borrow sits at a mere 7.8%. This pertains to the expense incurred when borrowing the shares. Furthermore, there's another noteworthy development: a 43% surge over the past 7 days in utilization, now resting comfortably at 74%. This is in stark contrast to the days when we oscillated between 80% and 85% utilization. It's puzzling that we've been unable to reach the coveted 90% utilization mark. One theory suggests that a significant chunk of block ownership from institutional investors may have been released onto the open market, thus increasing the availability of freely traded shares. Nevertheless, this remains speculative. However, we cannot ignore the fact that we're seeing a nearly 45% increase in utilization, an almost 50% surge in the percentage of the float, and a 20% rise in short interest. If we assume that AMC is considering or has executed a reverse stock split and share issuance, it's highly probable that short sellers are mirroring these actions, covering shorts only to open new short positions they didn't intend to close anytime soon. This surge in shorting activity is facilitated by the significantly lower cost of borrowing shares. Today's price action is particularly intriguing. The stock has seen a robust increase of around 7% at certain points, signaling that the speculations discussed yesterday may be unfolding. There's a distinct interest in the options market, with specific price targets emerging. Recently, we've witnessed a proliferation of price targets ranging from $40 to $45, with some even going as far as to suggest a $145 price target from Goldman Sachs, if memory serves. The crux of the matter here is that market participants have to hedge against this burgeoning short interest and their bearish positions. If we presume that, across various platforms, the reported cost to borrow numbers are down, it raises the question of institutional investors with large AMC holdings who traditionally lend their shares. If these rates are declining, it's likely they'll need to offer more competitive rates in the open market, resulting in reduced passive income from share lending. This is why I find it exceptionally interesting to monitor upcoming SEC filings from institutional investors who hold significant stakes in AMC. A noteworthy article from MarketBeat suggests that in the second quarter of this year, 3 hedge funds divested entirely from their AMC positions, while a fourth offloaded 22% of its stake in the company. This essentially means that an already retail-driven stock is now even more under the influence of retail investors. It's highly likely that individual investors now hold a larger share of the pie, particularly after the events of the second and third quarters. All eyes are on these forthcoming disclosures to gauge the extent of these changes, if any. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching,